On today's episode of Full Signal, I am joined by Katie Stockton. She is the founder of Fairlead Strategies and one of the most preeminent technical strategists in the world. She's worked on Wall Street for more than 20 years. She manages a fantastic ETF, and she brought the heat today on every sector in the S&P 500, what charts she's looking at right now, and where we're going in the new year. I hope you enjoy this conversation. Katie, it's great to have you here. I want to go through the recent sell-off we had in November, and we sort of had some chop and a bit of a rebound. Give us your big picture overview of how you're looking at markets right now.
Yeah, I would say it was definitely an interesting month in that we saw nearly a 6% downdraft for the S&P 500 and yet closed the month nearly flat. And that tells you that there's a lot of rotation going on, a lot of choppiness, if you will. And the takeaway, honestly, is more neutral, short term. That is, our current bias is neutral. And yet it does reflect deterioration that I think will resurface. And so we are expecting to move to a short-term bearish bias on the back of this bounce, with the thought that the initial decline was the A wave of an ABC correction. So I don't know if you've ever talked to an Elliott wave person.
Yeah.
And we're not Elliott wave theorists by any stretch. But oftentimes there's just a three-step process to a correction. It's the initial downdraft. It's interrupted, usually somewhat in the midpoint, by an oversold bounce or relief rally. And that's what I think we're in the midst of. And then followed by another downdraft. And it's that last downdraft that often is the most severe. So if we use that historical sort of precedent and apply it to the current environment, it would suggest that we're in store for more downside volatility. But of course, it's coming within the context of a really strong long-term uptrend. So we want to honor it as that and just be in the mindset of looking for buying opportunities.
So when you say short-term, how long is short-term typically? And if you still see a bullish long-term outlook, does that mean this is a buying opportunity?
Well, we hope it will be that, right? And we don't know. We can't predict it, but we can just try to put the weight of the evidence in our favors. And I think that short term can be anywhere from days to weeks, and in this case, probably weeks. So, we can live through that, right? A several week-long corrective phase as a potential buying opportunity. And what will differentiate whether it's either a buying opportunity or the start of a bearish reversal is essentially, does support hold? What kind of levels are in play? Is it impacting not only the short and intermediate term gauges like it is now, but also the long-term gauges? And by that, usually we're referring to monthly bar charts. So when the monthly bar charts and the technical indicators that we use start to show deterioration, that's when we start to worry about the longevity of the long-term uptrend.
I think that makes sense. Can you walk us through a bit of these specific charts that you're watching right now?
Yeah, listen, there's a lot of charts on our radar because it creates a mosaic from which we derive our opinions. And so every morning as part of our process, we're going through, I would call it top-down charts. So all the major equity indices, we're looking at fixed income proxies, we're looking at the futures across the board, we're looking at international markets, we're looking at commodities, FX, we're looking at crypto. And all of them taken together give us a sense of what the risk appetite is at the moment. And right now you can see that there's been a little damage to that, right? You'll see it in both the VIX, which is the volatility index. It's a good measure of transactional market sentiment. In Bitcoin, you're seeing that volatility and risk appetite having suffered recently. So those are two proxies that we would cite on that front. And then in terms of sector rotation, we give a lot of weight to that. And we feel that the rotations are pretty interesting as well. So the sectors are very near and dear to us. And we're watching tech having deteriorated at the same time defensive sectors like healthcare, for one, having really improved.
Can you explain that relationship a bit? Why are you watching the sectors and maybe the inflows and outflows to the sectors versus, let's say, the broader market?
Technology is essential to the major indices and the perception of the broader market because it impacts everyone's portfolios in sort of an undue fashion because it's such a huge footprint within these major indices and within the passive ETFs that many of us hold. So we really have to focus on technology. It's, I think last I looked, it was 33% of the S&P 500 in terms of market cap. So it will influence the broader market and investors' thought process. So it's key. And the way we look at it is from a technical perspective. Of course, we're watching for trends. We're watching for those trends momentum across different time frames. And then we're also looking at relative performance. And it's that relative performance that really faltered in November. Healthcare, I looked, it was up about 9% plus on the month, which is remarkable. And tech was down about 4 or 5% if you look at the S&P 500. So that creates a more difficult tape to take advantage of. And healthcare isn't usually the source of upside leadership in a very strong tape. It's usually something that people see as a safer haven, certainly than technology, which is very growthy.
So healthcare is one of those very unloved sectors. I think especially this year, United Health has had a bunch of problems that's made a lot of people bearish on the whole sector, I think. Tell us how you're thinking about healthcare right now.
Sometimes it's that bearishness that provides opportunity because we've had a lot of names trending lower or range bound, even in this very strong tape for the major indices. And that has now given way to improved momentum. If you look at something like Amgen, a huge company, that stock has broken out from a long-term range, or it looks like a bit like a triangle formation. Those tend to be bullish setups, longer term. And we're seeing more technical catalysts like that. So more breakouts, more turnarounds, more long-term momentum metrics shifting. And that can be opportunity. It's not necessarily as high probability as an uptrending stock might be, but these stocks, some of them appear to be entering those cyclical uptrends. So we're intrigued by that. We highlighted recently medical device names as one source of relative strength and also momentum to the upside. And why that's happening, that's for the fundamental analysts to answer. But for us, we're just intrigued that it is happening. And it provides some diversity from the tech stocks, for one, that have lost upside momentum and after having exhibited upside leadership.
Does anything about, let's say, how heavy or how tech heavy the market has become, does that concern you? Is that something you're talking to people about? Maybe we should get out of tech. How are you thinking about this?
No, we're not telling people to get out of tech indefinitely by any stretch, but we have told them as of about mid-October to dial back a little bit on that high beta tech exposure. And that's simply because it started to show signs of upside exhaustion. We have ways to measure that. So it's not just how we feel, it's how it is actually measuring up from a mathematical price perspective. And so we saw that start to happen in October. So we've asked, people to maybe dial back a little bit just to manage risk of that corrective phase that we believe that we're in the midst of. And yet the size of tech relative to the broader market, I wouldn't say in and of itself it's a concern. I think it's something we just have to embrace and adapt to. And, we're most interested in tech, I feel like, as an investing population. From my clients, the questions I get mostly are about technology stocks, semiconductor stocks. This AI trade has really instilled that even for people that previously were not that involved in technology. So people are excited about it. It is a growth sector. So I understand where it comes from. And rather than saying, oh, well, this has to change, I don't believe that that's the case. I don't think it needs to mean revert to anything, but rather we just have to tread cautiously.
I think it's very much a new normal of just this super tech heavy market, but also tech heavy world and tech heavy economy. I mean, everyone I talk to uses it way more than we did a few years ago. I mean, AI tools, of course, that's the big thing. Where do you fall on the comparisons to .com bubble?
Well, I lived through that, and it was really fun on the upside, a lot less fun on the downside. And it doesn't feel the same to me. So not to get too sort of touchy-feely on it, but to me, it had a much different character. I remember going into the office in the late 90s, and it would be a very broad-based move and a lot of gaps higher, subsequent, 3%, 4%, 5% moves day after day. And we might have had that at moments, but it wasn't quite as persistent, nor quite as parabolic as it felt at the time. And, maybe some of the sentiment data would have lined up, but we certainly don't have the crack in that if that's what people think it is. And there's enough diversity from a bottom-up technical perspective to suggest that we don't have that broad sentiment uplift that, is affecting all of AI.
Do you mean to say there's not the exuberance? Is that the right way to describe what you're saying?
Yeah, you could say that. And maybe some names have benefited from exuberance, but I wouldn't say on a broad basis that we have something that looks out of line with what the broader market has done of late. It seems very much in line, except for maybe some key components and pieces of it.
How do you think through the market today versus historical, like previous eras, when you're looking at only technicals? Are you comparing like the 99 chart to the 2025 chart, or how do you go about that?
We do that. We run analogs. We're very interested in studying markets and history, of course. But when it comes to making decisions and positioning and recommendations, it really is all about what's happening now. And it's we have in our minds how it looked back then too. Maybe we've seen this before, but the indicators haven't changed since 95 to now 2025. They to us have been enhanced. Perhaps we have more access, broader access via technology. And yet they send the same unbiased takeaway, which is really a gift from the charts. So we honor the short-term and long-term technical characteristics at this time, and we just try to stay on the right side of the tape.
So one of these indicators I know you track is the MACD indicator, the moving average convergence divergence. I am not really that familiar with this indicator, but I know you reference it, you cite it all the time. Can you walk us through why you pay attention to it and maybe why other investors should also be looking at it?
I think that's a good one to talk about because it is probably the most common one, at least here in the US. It is a trend following tool and also a momentum gauge. So it has this great nature to it where it is based on a spread between two moving averages of price. The moving averages serve to smooth out the noise in price trends. And it has standard parameters. And so it's using these two moving averages. And then it has a signal line. And it takes a signal line, which is effectively just a moving average of that spread. And that is there to generate the crossovers. And the crossovers hold information in the same way that the direction of the moving average based spread does. So there's a lot of great takeaways. We will assign a momentum characteristic based on the posture of the MACD, and we have it in 4 quadrants. It'll be positive, improving, deteriorating, or negative based on where the MACD lives and which way it's pointing. And then when we see those crossovers, that can be an unbiased buy or sell signal in a way. And it will be late. And I know that sounds like a negative, but in reality, it's not. It's there to discern important shifts over whatever time frame you're evaluating it. So a monthly MACD that's reversing lower or crossing over, well, that would have implications for months, right? Whereas a weekly one would have it for weeks. So we're very much attuned to what time frame we're evaluating it over and not giving too much weight, for example, to a daily MACD indicator when we're trying to have a long-term takeaway.
If it's a lagging indicator, can you explain a bit more how maybe the value you get in using that to look to make decisions from?
So it's telling you what the primary trend is, and that's what we want to stay on the right side of. It also will have nuances. So there's a histogram that you can derive from it where you can see if the momentum behind that trend is growing or contracting. So if you see an uptrend and the MACD's converging, well, then that gives you a hint that it might be losing some steam, and that can be incredibly valuable. So you don't have to wait for the crossover, of course. A lot of people do like to wait for it because it gives confirmation of a turning point as opposed to trying to get you right out at the top or in at the bottom. It'll give you that confidence in adding or removing exposure to take advantage of that prevailing trend. So it's really a good, sort of tool for the toolbox, but it's not the only one. We enhance it with what we call overbought, oversold metrics, like the stochastic oscillator. And we will use it relative to support and resistance levels, which is the visual takeaway from the charts that's so valuable. Where is there potential buying pressure, potential selling pressure based on market history, and the lags that are inherent to some of these moving average-based tools, they're not misaligned with the lags that we're seeing in earnings data or any other sort of way to understand markets. All data is historical, so we're just trying to inform ourselves based on that data.
So what is the MACD saying today? Like, what's the signal you're drawing from it?
Well, it depends on what we're looking at, right? Because we can look at the S&P 500 and it's still positive long term. So we do not have a MACD sell signal on the monthly chart, which I think people are probably happy to hear. We do have one on the weekly chart. And the weekly it's been positive since up until recently. It's been positive off of the April low effectively. So it is a shift. It's a meaningful shift. And that's why we think we're not going to be out of the woods yet for this corrective phase. But as soon as it crosses back up, we'll have affirmation, perhaps that at least an intermediate term low has been established. So we'll be watching it closely. We have indicators that we feel are a little bit closer to pivot points that we'll use in conjunction with the MACD just for more affirmation. And we don't have any buy signals yet over those indicators either.
So you're saying maybe the charts are saying we're not at the bottom yet of this dip.
Right. From an intermediate term perspective, a short-term momentum's obviously improved alongside this bounce, but in a way that I wouldn't necessarily try to take advantage of it unless you're a very short-term trader.
Okay. That I think that makes sense. When you're looking at all these charts and making your recommendations or allocations, how much do you factor in, let's say, seasonal trends? Because I know we're getting to the end of the year. Q4, December is supposed to be very strong for stocks, I think dating back to forever. Where do you fall on that as far as incorporating those insights into your analysis?
I wouldn't say we incorporate it as much as we think of it as good to know. It's good to know that there's a volatility pickup, typically August, September into October. And yet it didn't happen this year. So we don't rely on it. So we let it inform our biases at times when our momentum gauges like the MACD are aligned with that. But it will not drive our decision making because it changes. It's not necessarily historical correlations or seasonal phenomenon are not always going to be present year after year. We know this. And yet, so for that reason, we don't depend on it for our information. But if we see something else that would corroborate with whatever the December positive seasonal influences, that type of thing, then we'll certainly honor it maybe a little bit more.
Yeah, it's very, I think you have a very humble approach to your analysis because you always respect the trends, respect the seasonality, respect the data. And ultimately, it also seems like you don't give one thing too much weight in your analysis.
Yeah, we have a methodology. It's, we probably have a couple of indicators for each category, which is momentum, overbought, oversold, and relative performance. So we keep it relatively simple, and we try not to let our emotional biases get in the way of these indicators and tools that can help guide us. We also are very adaptable because we have to be. The market forces us into that. So I guess it's more of a respect for the market and, our inability to predict where it will be at year end, but our ability to put more probabilities on our side.
So what are some of your charts saying specifically about, let's say, Nvidia and the AI trade right now?
Well, we've been watching it closely, as you could imagine. And it's definitely been a great bullish impact on market sentiment this year. And I think it's partly responsible for the character of the tape, which has really been very momentum driven. So we've honored that. And we started, when we saw the S&P reach a new high in June, we noticed how noisy our traditional indicators had gotten, like that daily MACD for one. And so we said, you know what, this is a very highly momentum driven tape. So we're just going to focus on the 20-day moving average as our primary input. And I think it was the AI trade that was driving that momentum. So you watch the 20-day moving averages point higher months and months and months. And that's pretty unusual, mind you. I'd say it would be normal to see, some swoons over the course of several weeks. But indeed, this tape was very strong. And AI proxies, I usually use AIQ and, of course, Nvidia to watch the momentum. And I found that those 20 days really pointed higher for a long time. And it was only just recently that we saw them collectively roll over. Nvidia is a little bit of a different beast. It's obviously a bellwether for this space, but it had entered a consolidation phase earlier than most of the higher flying AI names. So I think it was maybe sending a bit of a message that the move was tiring out to some degree. And yet we're not at all bearish Nvidia. And we're honestly rarely ever bearish on stocks that are very close to all-time highs. It's not a great battle to fight. You don't want to fight that momentum. But we can certainly make the case for AI and Nvidia and tech more broadly to drive the next wave of the correction, because they have seen enough deterioration, those same weekly MACD sell signals, things of that nature, to suggest that a corrective phase is, already underway and has probably more room, and will also lend itself for a better buying opportunity, especially in names that had gotten really parabolic in their trends.
Real quick, we'll get right back to the interview. Just wanted to pop in and say, if you like this content, I write a newsletter every single morning called Opening Bell Daily. I cover macro, the stock market, asset prices, why things are going up, why they're going down. And if you want to get that for free, you can sign up at the link in the description. Let's get back to the interview. Yeah, it's interesting how you use Nvidia as a momentum indicator almost, because I know this year, I think we've been surprised generally at how much dip buying there's been from retail traders. Do you think that skews maybe the traditional analysis of using momentum as an indicator because there's just been such aggressive dip buying?
Well, I guess it did. It did definitely impact those indicators, the ones that are really attuned to the short-term swings. But it didn't do any damage, in my opinion, to the more smoothed out metrics, right? So the weekly MACD for one, not to belabor that, but it has been very, very timely. And it tends to benefit from trending environments. And the problem was with all those dips and the very short duration of those dips, the fact that they were bought very quickly, in other words, did impact the short-term indicators in a meaningful way. But that's just, again, something we have to adapt to, acknowledging that even passive ETF flows perhaps contributed to that as well. So I don't think that we can completely hone in on that just being all about retail buyers necessarily. There's institutional buyers there as well. And I think there's a fear of missing out that comes into play. So it really is a sentiment story too. So there's a lot of influences, and by the time we understand them, they'll probably change. So instead, we're just going to focus on the trends.
Such as markets. Yeah. What about Bitcoin? How are you looking at the asset right now? I think we're down about 10% in 2025. So that surprised a lot of people. We had the pro-Bitcoin White House coming in, and we had this deregulatory boom. People thought that was going to be the thing that pushed Bitcoin to, who knows how high. How are you thinking about the asset right now?
Well, it's also a correction. And so we can label it that as opposed to a bearish reversal by our metrics still. One of our long-term trend following tools, it's called the cloud model. One's a little bit more obscure and yet very widely followed, especially overseas, which is fascinating. And it's very applicable to anything that trades globally with high liquidity. That includes Bitcoin. So we rely on the cloud model, and the cloud model shows support for Bitcoin just shy of 81,000. So it's important to us that that support holds, because below it, it would suggest that it is indeed something that's more of a bearish reversal, like a cyclical down move, still perhaps within a secular up move, but something that could persist. So we're very closely focused on this key support level. And we're also watching the indicators really closely because we've seen a very distinct loss of intermediate term momentum. It's to the downside now. And yet long-term momentum, there's a monthly MACD sell signal pending. So we have an unconfirmed monthly MACD sell signal. If we see that sell signal confirmed this month, well, that could be a problem. It could suggest that support's vulnerable, and then that would put us in the mindset of being better sellers of a relief rally. The reason to assume there will be a relief rally that will get Bitcoin to a better price to sell if people were inclined to do that is because, and it's a good time to talk about this, for the first time since 2022, we have a potential counter trend buy signal on the short-term chart, so the daily chart in Bitcoin. It's based on the DeMark indicators. Those are Tom DeMark's indicators. And they're also widely followed, albeit not accessible to everyone. But these measures are designed to gauge trend exhaustion. And so if we see the signal, which could happen as early as tomorrow, it doesn't have to happen, that would have us, I'd say, attuned to what's happening with momentum. It would be one reason to expect support to perhaps hold despite that loss of momentum. So we have some dueling influences between the longer term setup and the shorter term one, looking overdone.
So to try to translate that into maybe more colloquial talk, short term could be more choppy, potential downside. Long term still bullish, is that right?
It's sort of.
Okay.
So the short term, of course, could be choppy, but this potential counter trend signal would be to the buy side. So it would suggest that Bitcoin is in store for a relief rally, and that relief rally would have the potential to preserve the long-term uptrend.
But the relief rally could also be a selling opportunity.
If it comes on the back of a breakdown, then we'd think of it as a selling opportunity. So it depends on where Bitcoin is relative to that support level in our work. It is a key gauge, and we are concerned by the loss of long-term momentum, but it's still early. We don't have a confirmed signal yet. So it's a bit of a transition period potentially.
Yeah, this has been a crazy couple weeks for Bitcoin, and so many readers and other investors are pinging me about where I think Bitcoin's going or what it's doing. And, I certainly don't have the answers. I talk to folks like you who do have the answers. I want to ask you about your ETF. Can you give us the elevator pitch on sort of what you're doing and the research that goes into managing this product?
Yeah, of course. So it's called the Fairlead Tactical Sector ETF, or TACK, T-A-C-K. And we are all about sector rotation, as mentioned. And so what we feel is that the market offers almost low-hanging fruit in terms of sector relative performance. If you look at any year over year, there is a huge spread in the sector winners and losers. And that's something that investors can take advantage of. But what we found is that our clients who were doing that, they were over trading in a way. They were incurring a lot of taxable events by trading in and out of the sectors on their own. And so we wanted to create this ETF wrapper, they call it, around that kind of strategy, and to have also a technical methodology behind it to make it systematic. We wholly believe in systematic investing. We also believe in being long-term if you can be long-term, because in all of our back testing and all of our experience writing research, we found that the long term is the most beneficial time frame to eliminate the noise and transacting too much. So our fund is long term in nature. It uses only monthly closing data. And we start with the sectors using the sector spider ETFs. And we're evaluating them for momentum characteristics, overbought, oversold signals, relative performance. And we're effectively choosing the best 8 of those sectors if they qualify. And that becomes our entire TACK ETF. So it will be 8 equal weighted sectors in a strong tape. But there's, of course, tapes that aren't so strong in which none of the sectors are doing well. 2022 is a good example of that. And for part of 22, we had only the energy sector in there. So what we do, we still keep it at the same size, about 12.5% of the portfolio. We put the rest of those buckets into alternative asset classes. So US Treasuries, we'll use short-term and long-term Treasuries, and gold. And that's our way to limit drawdowns in the equity market. And indeed, it's managed to do that.
And is there Bitcoin in this or no?
There is not.
No Bitcoin.
It's not part of the mandate for this fund.
Okay.
We do hope to have a crypto rotation product, down the road.
That's pretty exciting. Is there something like this that your competitors are doing, or is this a pretty unique product, you'd say?
It's unique in a couple of ways. One, that it is driven wholly by technical analysis. Two, that it's an equal weight sector strategy. Often you'll see that there's more concentration in sector-focused products or thematic products, and they'll get very heavy technology for one. What TACK serves as is almost a great core long-term holding, especially for folks in their retirement accounts or on the verge of retirement, because it will give you exposure to the best sectors while also not being highly concentrated in tech. So our goal is not to look just like the S&P 500, but to serve as a core that will invest in the tech when it's working. But when tech is the only thing working, it needs to be supplemented with technology stocks and higher beta positions. Tech ends up looking very low beta and low correlation to the S&P and to its benchmark.
And what's the AUM at now?
About 275.
Wow.
Yeah, so we're proud of that.
That's incredible.
Yeah, it's our only product, so we're excited. Yeah.
All right, Katie, can you share where people can find you online?
Of course. So at Stockton Katie on Twitter, or X, I should say. We have two websites, fairleadstrategies.com and also fairleadfunds.com. And through the Fairlead Strategies website, people can sign up for a free trial of the research, which I encourage. We're also on Substack with a newsletter there for anyone to check out individual stock ideas once a week. We write for CNBC on a regular basis as well, so they can find us there. It's hard to hide these days, isn't it?
You're everywhere. Yeah, it's unbelievable. Katie, really appreciate you taking the time.
Of course. Glad to be here.
Yeah, thank you.